All right, today we're going over the origins of the Japanese candlestick. Homna Manisha, I pronounced his name wrong, is basically the creator of the Japanese candlestick as we know it. So we're going to go over the background about Homna in his early life, some of his philosophy, a little brief description of candlesticks, and the most important thing, the treasure chest at the end, the resources, where you can find them. So Homna's background, he was best known for creating the Japanese candlestick. He realized the price movement in a market reflected the psychology of the market. So it brings me to this quote right here. The psychological aspect of the market is critical to trading success. So he lived from 1724 to 1803. He was 79 years old. So this was before Charles Dow. And you're probably wondering, why didn't I start off with this? You'll see why. So this is before Charles Dow and the Dow Jones theory. He was born into a wealthy merchant family in Japan and rebelled against his father's wishes and traded in the rice pits in Osaka, Japan. And this was during a time where there was still feudalism in Japan. So the samurai, the warrior class, was above the merchant class. However, his father was really well respected, and his family's business was as well. So trading was considered gambling to most in those times, and that's why it was such a big deal. It was an honor thing. It's part of their culture in those times, not to gamble. He ended up being one of Japan's most successful traders, and sadly his father wasn't able to see that. But a lot of people that fear investing or fear the market or trading, it's just they don't have the knowledge. And so it's easy from their perspective to look at it as gambling. And that's okay. You're going to make that argument with people all the time. There's just people really good at trading and gambling as well. So Homna's trading style, he was a part-time trader who traded in the rice commodities market in Japan. Homna had run the family business. He had to after his father died. He would use some of the profits from his business to trade if his business was doing well. He would also fund his business with his winnings from trading. If the business needed a little bit more capital to venture out or expand, he would use his winnings to help out the business. So it's sort of like a hedge fund. So when trading wasn't that good that day, he focused more of his time on making his business better. When his business was doing great and he had more time to trade, he would be trading more. He became a billionaire in today's money. He ended up losing everything and eventually made it all back and then some. So yes, he blew his trading accounts multiple times, and that's just how it goes. It's part of the learning process. If you're watching this and you've been trading for 4 or 5 years, you are part of, it's normal. It is normal. It doesn't mean you're a failure. You could be the best trader in the world. You just don't know it yet. And so this is a image of the rice pits in Osaka, Japan. And it was pretty crowded. It was pretty crowded back in the day, and it was very loud, and people were buying and selling quickly. And there was a lot of transportation in that area. The sea was there. A lot of rice was moving in and out of Osaka at that time period. So some of his philosophy was that what Homna realized is that the market can change because of a random event. So weather, seasonal demand, disasters, harvest times, innovations, it all affected the rice market. So that brought him to fundamentals. And this is just from his observation at the time. So he paid attention to detail. He observed the price move and react to certain events. Technical. In price movement, he saw that when price trends in the morning, it tends to continue in the same direction throughout the day. Now remember, back then, they didn't get their news 24/7, 7 days a week like we do it during this time. So a lot of it was rumor or word of mouth. So this was more of a reliable way to trade back in those days. The one thing he didn't really do is trade ranges. And so when he did recognize that price tends to stay on the same trend, if the market was ranging or there was slow price movement, it was too choppy for him to make a decision. He wanted to see power behind the candlesticks. So if the price was going up, he wanted to see power behind that candlestick movement. And so fast price movement usually meant smoothness to him. So think about it like this. You're on that Boeing where that door flew out. It was a MAX 9, I believe. And you're on the plane, you're a trader. And so you decide, wow, that door just flew open. They could ground all the aircraft and it might make the stock plunge. So you're the guy, you're the woman in that seat, or you're the pilot that knows about this, and you buy puts or you start to short the market. There's no way me at the New York Stock Exchange will know that that's happening right now until the plane lands. So we're going to go over insider trading and all this later, how I don't think it really matters. But you're not going to know about these events until after. And everyone's going to groupthink and herd mentality into the trade. So since there's no way of you knowing this, for him, he decided not to trade ranges. So if you buy or sell in a range, you have no idea which direction price will go. So usually a range or sideways price action really means that the buyers and sellers are in an indecision point. When there's strong buying in the market and candlesticks going up, all that is buyers in control. If it is inverse and the candles are going down, that means the sellers are in control. That's predictable. That's something that you can join if there's enough momentum. So we're going to just briefly go over the candlestick. And the most important thing is a candlestick just records data. It's just record keeping, really good record keeping. So we're going to pretend that this candle represents one day, right? So in the morning when the first bag of rice sold, the price of the bag was right here. At the very end of the day, the last bag of rice sold would be the close price. So between the open and close price would be the body of the candle. Now, price did trade above and below the open and close. That happens. That would be your price range, and it's annotated by this wick. So the highest price that a bag of rice sold during that day is at the top of this wick. The lowest price that bag of rice sold during the day was at this wick. Now, the red and green. So pretend that this candle is already closed. This candle is red or in the negative or going down because the close price is below the last close price, right? So if the price went this way and closed, this would be a green candle. If it closed at the top of this wick, this would be a green candle. So in order for the candle to be red or green, it highly depends on if the price closes below the close of the last candle. And this will make sense later. So typically you will see red and green candles representing positive price movement and negative price movement. Note, In places like China, you'll see the opposite because red is a positive color in China due to their government and culture. So we'll get into candle colors later, but let's go ahead and pull up a chart. And this is my beautiful drawing. So when we were going over the Dow Jones theory and Charles Dow, we did move into line charts and how they're made. So this is the line chart. This is the same price movement, right? Only this data has more information. So you can see that during a downtrend, there are still white candles. I prefer white because it's easier on my eyes. These colors, I use dark theme because it's just easier for me to look at the chart. But you'll notice during a downtrend, you'll see these white candles in between. It just means that this close was higher than this close. So there was a positive price movement as the market was going down. That always happens. And you're going to start scrolling across and you'll see some patterns. You'll start identifying some patterns. So each candle in this scenario is based off the 4-hour time frame. So each candle represents 4 hours of price movement. If we click to the daily, a fractal, you'll see that the daily candle, that means each candle is the daily price movement. So this happened in one day, this happened in one day. And if you we'll go to the 5-second chart. This is the 5-second chart. And when you look at a live chart, you're going to see the candle open positive. And it closed. Closed positive. This closed positive. This, there's a gap. There's gapping. But you'll see live that these candles, let's look at the 1 minute. You'll see these candles, if it's not closed, this does not mean it is a positive candle because it could flip with 12 seconds, 10 seconds left. It could just dump. So you do not know what this candle is until it closes, and we're about to see in a couple seconds. So now that that candle is closed, that is the closing price. And as you see, this candle is red because it is below the close price of the last candle. And it just continues on. So we don't know for a fact if this will close in the red. Going back, so you're going to see patterns in the chart, and we went over fractals and fractions and the Dow Jones theory in the Dow Jones slide. So we're going to go over a little bit about patterns, not too much. So the thing about patterns is in fractal nature, they repeat. It doesn't matter what side. It doesn't matter what side the pattern is on. So if you have a top on your chart and it's a pattern such as a triple top, if you flip this upside down, it would be a triple bottom. These patterns work in uptrends and downtrends. Almost every pattern you see will work inversely or flipped. It's just the fractal nature of how people trade. So bringing this triple top into perspective, if you look around you, nature happens to work in fractals as well. So this isn't something that's not familiar to you or anyone. Our brains are hardwired to recognize patterns. It's just natural. Our natural world somehow makes patterns. So this pattern of the mountain, look, you can see a downtrend. And what happens after that downtrend or triple top? right? A reversal, a reversal in that pattern. You can find this everywhere, in basically essentially everywhere in nature. And it's just easy to recognize. Our brains are hardwired to recognize patterns. I just want to go over that. It will be relevant later. So here we're going to go over some resources quickly. If you type in Homna's name in a search engine, you're going to find that there's not a lot of information on him. So the reason why this portion is the most important portion of this is when you do your own research, I have some breadcrumbs for you to follow. So I came across the Japanese Forex trader Kai. This person is really awesome for spending the time to make a 5-part video going over the origins of Japanese candlesticks. He has a lot more, but I just really think it's amazing that people actually put their own time in and give out free education. This is for free. And so will go over way more detail than I did. And some of his material helped me make this video, of course, but it's really good information. He explains it so well, goes into much more detail. So this is some research that you should do on your own. The pattern site. So Bulkowski's the pattern site. This guy is a day trader. He's really good. He's really successful. This is actually the first place I went to research patterns for free. He talks about Elliott wave theory. He talks about so many different patterns. So a lot of patterns that people try to study are reversal patterns or continuation patterns. So you're going to see that a lot of the things they call a triple top in the market will be named something else in another market, like a Wyckoff, or there's many different names, but this is a good place to start. He has a ton of resources. He wrote tons of books, and Honoma wrote a ton of books too. He wrote 4 or 5 books. You can pick up some of his books, and these are the original books he wrote. So you can get it as he saw it from his perspective from the 1700s. So moving forward, in summary, candles are a historical record of price action. That's all they are. Candles have more data to go off of than a typical line chart. You can still identify trends and patterns in a candlestick chart. So it's easier to see it maybe in a line chart, but once you get used to the candlesticks, you're gonna prefer more information. You're gonna want to know what the open and close price is, for example, for the weekly. That's gonna be important. So are the daily. The daily open and close prices are important as well. But you can switch between the two pretty easily, and I'll demonstrate that real quick. So your candlestick chart and your line chart, you can switch between them pretty easily. This is easy to recognize trend, like we're currently in a downtrend. And then locally we're in a uptrend, right? Higher highs, higher lows. And then you can also see that in the candlestick pattern. You can, if you drew a line, you can see that we're in a downtrend. And no, this doesn't mean we're in an uptrend, and I'll go over that later. But yeah, it's you just have to get your eyes used to seeing something different. So the key point in all of this, and it's all gonna come together, is using Confluence may increase your probability of winning a trade. And that's what he used. He used fundamentals and some technicals. And there's a lot of traders out there, but one of the trading styles is quantitative trading, and they call them quants, but they use a heavy amount of data to make informed decisions. One guy So you don't want to be in analysis paralysis. One person can change the entire market you're trading, and you will not know about it. So keep that in mind. Data is reliable. It's a good benchmark, but one thing can go wrong. A flood, a hurricane, an attack on a infrastructure, or a bridge falling down, or a plane door flying off. Data has its limits. All right, guys. I want you guys to stay the course. You have to learn this if you're serious about trading, and stay the course. Keep practicing, keep learning, go on the charts. You should be researching everything I just showed you on your own to come up with your own opinion, your own perspective, your own bias. All right, good luck to y'all. Stay the course. Trust me.